Markets are soaring right now. Big news came out this morning. Let's break it down right now. So, Mo, what the heck happened this morning that the Nasdaq's up 2.3%, the Dow's up 1.38, and the S&P is up 1.8%, and it's only 35 minutes into the trading day?
So CPI came out.
CPI.
Expectations were that we were going to have an increase month over month of 0.1% and a year over year increase of 3.3%.
But what happened?
That didn't happen. Prices rose 0% over last month and 3.2% over the prior year, so it beat all expectations.
So why are markets soaring?
Because this is what markets do.
Well, but what's their interpretation of this data?
I think if it would have gone the other way, they would still be soaring.
No, I actually do you really think so?
Yeah, I do.
Oh.
I think it's concocting a story of just sending markets one way.
But the idea here is that people think, oh, Fed's not going to raise rates for sure in December. We're done with Fed rate hikes, et cetera.
So it's interesting. When was the last rate hike? Do you know? Was it?
Oh, I forget.
4 months ago, maybe?
I don't remember. You probably Google it pretty quick.
I mean, so the number keeps coming down as the interest rate number is not going up. So does that mean that kind of Powell did say we're going to stay hard, and if we need to raise it again, we will. But it's proving that they don't need to raise it.
Not necessarily. Now,
for now.
So everybody's perception is we don't want rates to go up, right? Mm-hmm. We don't want rates to go up.
Because it's more expensive to borrow money, et cetera.
Correct. So the markets go. But the interesting part is we're at a point on the S&P right now of 44.92. When we started raising rates back in March of 2022, a year and 8 months ago, guys, we're flat. Rates were 0%. They're now at 5.25, 5.5, and markets are flat. I don't understand this. We're not at all-time highs. We're pretty freaking close to it.
Yeah, and there was that big fall in October of 2022, and the rationale there was we're raising rates too much. This is a disaster. And
markets were down a lot. And this year,
higher than they were in October of 22.
Now, the interesting part is what would cause, I just put this on Twitter today, what would cause the Fed to lower rates?
I really think it's that 2% target.
No, to lower rates. What would be the reason the Fed would say we're gonna lower rates? But why would they lower rates?
Because they achieve their goal. That's what I think.
So I disagree.
Okay.
I think the reason to raise rates is you want an expanding economy. Why would we want an expanding economy? Because there's a recession. Mm-hmm. So I look at this thinking, and you go look at history, when rates start to get lowered is when a lot of stock prices start to fall. Why? Because you're in a recession. So I look at it thinking to myself, wow, people want rates to go high, rates to go lower. But in order for rates to go lower, it's not just because the Fed goes, oh, we're good.
So let me ask you this.
Yeah.
Let's say they get to that 2% inflation number, but labor doesn't change because the unemployment number is still very low.
That's the thing. Unemployment's a very inflationary.
Then?
Yeah, that's what I'm looking at going. Unemployment, first off, we're at 4% core inflation.
Right.
They want to be at 2%.
I know.
That's still double.
It is. It's a long way to go. I think if they got to 2% and the unemployment number was still where it is, I think they would start trimming rates back down.
Maybe you're right.
Which is what I think.
But then you're going to start causing unemployment,
issues, right.
and then you're going to cause inflation again. Mm-hmm. Listen, decreasing rates is supposed to spur growth. Spurring growth spurs inflation. Mm-hmm. Increasing rates is supposed to slow down inflation and therefore slow down growth. But yet now we're seeing that there was a big jump in GDP last quarter. This is melting everybody's brain. This is why it's so hard to determine what's going on.
Right.
But
that's kind of why I think even if inflation number didn't come in beating expectations today, the market would still go higher because it's just all over the place.
Maybe you're right.
Who knows?
So you look at the overall market. 2 years, a little under 2 years ago. Mm-hmm. No, a little over 2 years ago, people were hyped about Nikola, Tattooed Chef, all these garbage companies. Yeah. And all these garbage companies now are down 90, 95 or to zero, right?
Right.
That was the outside layer. Mm-hmm. How many stocks did I own a year and a half ago? 5?
Yeah.
I own 14 now. So all these, and I don't buy small companies. I buy 10 to $100 billion companies, 200 billion. I don't buy these small, like $100 million companies. Mm-hmm. And now I'm finding more value in those areas. We're finding companies like PayPal, Generac, which are down 80% from their all-time highs that are now into my range. Those have broken down, and they're getting better buys now. So what's holding up the market? The Magnificent Seven. It's these largest companies. Why you say that, make that comment?
That's it.
That's exactly
it.
it.
That's all the thing.
If you look at the dot-com boom, that's what it was. It was a bunch of really large companies holding up the entire market. The small cap companies, small mid-cap companies were undervalued. What do you see now that's happening? People are talking about how undervalued small cap and mid caps are. I haven't looked at it, so I don't know exactly. But then you look at the share of tech relative to the S&P, it's at a higher level than it was in 2000. And these Magnificent Seven are just completely irrational.
Yeah. I mean, it was funny to see Nvidia at basically $400 a share 2 weeks ago, and today it's almost $500 a share. I mean, that is totally absurd. For that, the price action is not absurd. It's absurd for $1 trillion company to be moving like that.
Right.
That's what's
It was
crazy.
at 398 on October 25th, and now it's at 485, 490.
And I said this in a video last week. If I had a house and it was built on 500 stilts holding it up, and 493 are down, and there's 7 holding them up, now what are you going to do?
Yeah,
you think
correct.
that's a good idea? You going to go and live in that house?
Yeah, it's absurd, and it's like, listen, that's the thing about stocks. It's not like a house where you don't have Zillow on top of your house every single day updating under the value. Because
Right.
I'm sure if it started to go down, you would start sweating.
We would have an awesome real estate market if that was the case.
Well, yeah, 2008, 2009, 2010, 11, 12, that was a great real estate market.
Imagine coming home at 5 o'clock every day and looking and seeing a ticker symbol up there.
You know,
What
Mo,
a
I've learned
close
a
that.
lot from this market. You know, the whole old adage of stocks can stay rational longer than you can stay solvent. It's amazing.
Yeah.
I just got a text from my banker saying, Paul, we got to move some money over to cover some of these shorts. I'm like, okay, sounds good. You know, that's it's hard because the volatility on these things is so great, and it makes you feel, some people feel like FOMO. Oh my God, I'm missing out on this. Look at these companies that are up so much. But here's the interesting part. A friend of ours, their mother messaged me back in June or May about Tesla. I want to buy Tesla. It was at 245. It went up to like 280, 290.
Yeah.
Now it's down to 230, but it's up a lot today. It's up to 230. It's like, here's a company that's absolutely, hey, guys, forget about the stock price. Look at the fundamentals of that business.
Yeah.
Revenue skyrocketing. They're growing like crazy. It's amazing. And yet the stock price is down from its all-time high. It was at 415 all-time high, got down to 102 back in early of January, and now we're here. Now, this all works together because interest rates, as Warren Buffett says, work as a weight on stock prices. But yet we haven't seen that.
Right.
March 13th, I think they started raising rates of 2022.
Okay.
And where was the S&P then? Can you pull that up for us?
Yeah.
You look at this and think to yourself, oh my God, if I told you rates are going to go from 0 to 5.5% in the 90-day treasury. Interestingly enough, my brother's in a group chat with a bunch of family offices, and they were looking at a deal. And the one guy said, this deal isn't worth it. Why would I want 11 or 12% of this deal when I can put 90-day treasuries at 5.5? And I was like, that's the key there. What was it in March of 2000?
The close was 417 on March 14th of 2022.
And we're now at
447.90.
So we're higher than we were back then.
Yeah.
Amazing, isn't it? On the S&P 500 ETF SPY.
Yep.
Incredible. So we're up 10%. Rates have gone from 0 to 5.5%. Somebody explain this to me. Somebody explain this to me. It's tough, guys. The stock market GDP ratio, even with increasing GDP, is still overvalued by over 70% based on history. The 10-year cyclically adjusted PE ratio is currently at 30.39. We're back over 30. That's a huge number. Huge number. It just says the next 5 or 10 years are going to be very tough to make good returns in the market. But guys, that's what we're here for. If you like this, subscribe to our channel. I guarantee you'll have a better understanding of money. We're just here to talk about the markets and the economy and what they mean, but we're not trying to make guesses in the short run because that's literally impossible. Thank you very much for your time.